Hello and good morning, everyone. Welcome to another episode of the Market Snapshot series. My name is Rufus Kamau, Markets Analyst at FXPesa. So today we'll be talking about the top events that are expected to be moving markets today. So earlier on, just about an hour ago, we had data coming in from the UK showing the health of the UK job market. The job market report was weak. And as we have seen so far in the price action for the last 1 hour, the UK pound has weakened. Well, on the other hand, the benchmark stock market index, the FTSE 100 or the UK 100 index, managed to rally again and now aiming into new all-time highs. So once again, welcome to the session. Remember that this session does not constitute of any form of investment advice. It is not a recommendation to trade, so you should always do your own due diligence. So once you join in, can just say hi on the live comment section, and these will confirm that everything is working just fine. So let's start with a summary of how currencies have performed as of this morning. So if you check from the FinViz website, you'll notice that relatively the US dollar has been strong this morning with the best performance in the market coming in from the Japanese yen, which is up 0.28% against the dollar, whereas the worst performance has been from the UK pound, which is down 0.41% to the USD, mainly as a result of the job market report that led to the weakening of the pound. So, on the other hand, if you look at the month-to-date performance of currencies, the Australian dollar is still king. So after 2 weeks ago, they decided to hike interest rates among the first central banks to do so. We saw the Australian dollar strengthening. Also, the correlation with gold has been helping the Australian dollar. So the yen is also up 1.09% since the month started, whereas the UK pound seems to be the biggest loser, down 0.83%. Then year-to-date performance, Australian dollar and New Zealand dollar are still king. Swiss franc is third, whereas the yen is fourth. Whereas the weakest currency since the year started has been the US dollar among the major pairs. So, what happened this morning after at the UK job market report? So, before we jump into that, you should notice that yesterday was largely a big bank holiday. So, ranging from a bank holiday in China, where they are currently observing the Spring Festival after the Chinese New Year. Then we have the Canadian bank holiday. This was in observance of the Family Day holiday. So the banks were also closed, and of course, US stock markets were closed yesterday due to the President's Day holiday. So knowing that the markets were largely quiet yesterday, today we expect volatility to resume, though it's still a bank holiday in China, but then for US and Canada markets are open. So fast forward to this morning, German final CPI came in at 0.1% as expected, same as the prior month, so not much of a change. But then we had big surprises happening with the UK job market report, starting with the claimant count change. Claimant count change is basically the number of people claiming for unemployment insurance for the first time. And unemployment claims were up to 28.6 thousand jobs. So 28.6 thousand people claiming for unemployment insurance because they couldn't find jobs. And as a result, this was higher than the expected 22.8, and of course, way higher than the previous report of 2.7K, which was revised higher from 17.9K. So when you have more and more people claiming for unemployment insurance, it means that the job market is weak and people are not able to find jobs easily. So on the earnings side, the wage growth was also slowing down. So from a prior reading of 4.6%, this is a quarter of a year, we expected the number to largely remain the same, but wage growth slowed down to 4.2%, which is not a very good indicator of economic growth. Then we had unemployment rate, which spiked higher from 5.1% to 5.2%. So what does this mean? On one side, we know that the UK economy has been largely struggling with the fiscal side, And now looking at the number of people claiming for unemployment insurance, it shows that the job market is not doing well. Also, manufacturing and services are clearly not doing well because if they were doing well, then they would be creating these jobs themselves. So on the other hand, there's the issue of the monetary policy by the Bank of England. So we know that the Bank of England has largely maintained interest rates relatively higher. So yeah, as per the last meeting, the interest rates in the UK remained at 3.75%. So here what we are seeing is a worsening job market, and a worsening job market basically means that just a sec. Worsening job market basically means that it might trigger the Bank of England or pressure the Bank of England to go for more rate cuts, which would be positive for the stock market. And I believe that's the interpretation as for this morning. So that explains why we are seeing a strong rally in the UK 100 index, but then also seeing a weakness in the UK pound. So going forward for the rest of the day, we'll be having the ZEW Economic Sentiment Survey for the Eurozone as well as for Germany at 1 p.m. Then we will be having the ADP weekly employment change from the US side. That's tentative between around 3:30 to 4:30. And then the main card for this afternoon will be the consumer price index data for Canada, showing the level of inflation. So we know that the Bank of Canada, usually focuses on the trimmed mean as their favorite measure of inflation. And as per the prior reading, inflation was at 2.7%, and we are expecting this to drop to 2.6%. So a further drop in inflation would basically mean the bank has more room to cut rates. So as a result, we could be seeing a weakening Canadian dollar, but also a spike in inflation would also strengthen the Canadian dollar. So that will be just about it for the day. Now we wait for the next big data release, which will be happening tomorrow at 4 a.m. And this is an interested decision by the Reserve Bank of New Zealand, where they are largely expected to maintain interest rates at the current level of 2.25%. More focus will be put on the monetary policy statement, the interest rate statement, and most importantly, the Reserve Bank of New Zealand press conference at 5 a.m. tomorrow. So then at 10 a.m., we'll be getting the official inflation data for the UK, where inflation is expected to have dropped to 3.0% in the month of January, down from 3.4% in the prior month. So such a drop would give the Bank of England more room to continue holding rates higher. But then if there's a spike in inflation, if there's a spike in inflation, that's when we should be expecting rates to remain high. But then if we see a significant drop in inflation, then that means that the Bank of England will feel more pressured to cut interest rates further. So the rest of the data releases will be covered in tomorrow's market snapshot. So make sure that you're prepared. Also remember that the FOMC meeting minutes will be coming in at 10 p.m. Then another speech by Reserve Bank of New Zealand Governor Breman at 10:10 p.m. So fast forward to the rest of the week, we'll be getting job market data from Australia. This will be at 3:30 a.m. on Thursday. We'll also be looking at weekly unemployment claims as well as the Philadelphia Fed Manufacturing Index. Then pending home sales from the US at 6 p.m. on Thursday. Crude oil inventories at 8 p.m. on Thursday. Another speech from the Reserve Bank of New Zealand Governor Breman at 2 a.m. on Friday. Retail sales data from the UK at 10 a.m. On Friday. Then the S&P Global Flash Manufacturing and Services PMI across board for the Eurozone, for the UK, for the US, all in the same day. We also get advanced GDP data from the US and, of course, the Fed's favorite measure of inflation, the core personal consumption expenditures or PCE price index at 4:30 p.m. on Friday. Before we look at the S&P Global Flash Manufacturing and Services PMI for the US economy on Friday at 5:45 p.m. So clearly, it's a week for the UK pound traders, mainly because from today we get the claimant count change at 10 a.m. Then fast forward to tomorrow, we get the CPI data for the UK economy. Then on Thursday, from the UK side, we won't have any major news on Thursday. But then on Friday, we get even more data, which will include the retail sales data, as well as the flash manufacturing and services PMI data at 12:30 p.m. on Friday. So if you've been looking for a volatile week for the UK pound as well as for the UK 100 index, then this might be the best week for you. If you prefer no news, then you might as well look elsewhere for a much calmer currency without out of news announcements for the week. So I'm seeing already some people have joined. So thank you guys for joining and commenting. You can see Night in the house. Hello and good morning. Good morning, Lucy. Also a good comment from Mahabur. Want to learn how to analyze market? Please learn us to build us. Definitely. So how are you saying we are having worsening job reports? Last NFP data and unemployment claims come in higher than expected. Can you then clarify what NFP actually measures? Well, I think you got it all wrong. So this is job market data from the UK that was released this morning. So NFP is simply short for non-farm payrolls, and where we get the non-farm payrolls is the US economy. So those are two different economies. So the job market report for the UK economy is the one that came in weak. US non-farm payrolls were much better than expected. So good morning, Mr. Patrick. Thank you for joining. So let's continue with the presentation today. So what are the other key highlights that are happening in the market as of this morning? Of course, there's the worry about the AI trade. So investors are wondering whether the market is going to continue to sell off from where it left last week, or whether there will be recovery. So US stock futures fall in shortened week, AI disruption in focus. So a lot of bets in AI, basically seeing a lot of rotation as investors grow more conscious of AI investment risks. So other than that, trying to see if there's anything else. So as per last week on Friday, you can see how the stock market closed, mostly in the green, though some major counters had quite a negative day on Friday, with Apple, Nvidia, Broadcom, and Google, as well as Meta losing. But then a majority of the market was in the green, so we should be looking at the continuation today to see how the market picks up. So this is how it looked like. So as you can see, most of the stocks in the SP 500 were in the green. So as per the RBA monetary policy meeting minutes, the Reserve Bank of Australia said on Tuesday it had concluded inflation would stay stubbornly high if it had not hiked interest rates. So in other European trades, the Pan region Euro Stoxx 50 futures were down 0.35%. The German DAX futures also said 0.39%. The FTSE was down 0.18 before the release of the job market data. And US stock futures SP 500 E-minis were down 0.46%. So, key developments that could influence the markets today are one, earnings from Kerry Group, Intercontinental Hotels, as well as Carrefour. So, we also be getting German CPI final for January. That's already out, 0.1%. So, ZEW surveys for the Eurozone and Germany, that is not yet out. Then the UK jobs data is already out. Then on the debt side, the opening of the 2-year debt auction in Germany, reopening of 2-year and 6-year auctions in the UK. So sometimes, especially when there's a big divergence or influence of investors in the bonds market, it can have an impact on the forex market. So other highlights on the Forex Factory website is that one, there's key negotiations that are expected to be going on today between Trump and Iran. So Iran wants to make a deal with the United States, and this is already impacting oil markets. So if there's a positive development in the Iran-US nuclear deal, that would mean that the markets remove some form of premium from the oil markets. So we could be seeing oil markets dropping with positive progress on the Iran-US negotiations. So from the Reserve Bank of New Zealand, they decided to hold interest rates, but clients brace for 2026 OCR hikes. So there is expectations that at some point the Reserve Bank of New Zealand will follow suit with what the Reserve Bank of Australia did. And if they go for interest rate hikes, then that would likely strengthen the New Zealand dollar. So other than that, I'm trying to see if there's any other highlight we may have missed. So US 10-year yield hits 2.5-month low. So yields are going down again, bonds in demand. So at some point, this should be having a positive impact on the dollar. Other than that, gold falls for second day. Gold dropped nearly 2% to below 4,900 an ounce on Tuesday. But then we are already seeing a very strong pickup. It looks like a lot of traders have been buying the gold dip, and we are on course of reversal back to the mean. So mean reversal could be in play right now as we speak. So oil drops ahead of US Iran talks. WTI crude oil futures fell to $63.4 per barrel on Tuesday after rising 1.4% in the previous session on heightened tensions between the US and Iran ahead of a second round of talks. So I believe those are some of the key highlights as of this morning. So also notice that for the UK job market report, the unemployment rate rose to 5.2% in the 3 months to December 2025, slightly above market expectations, which had forecast it would remain unchanged at 5.1% from the prior period. So this marks its highest level since the 3 months to February 2021. Total unemployment increased by 94,000 quarter on quarter to 1.883 million, driven by rises in the number of people unemployed for up to 6 months, between 6 and 12 months, and over 12 months. Meanwhile, total employment rose by 52,000 to 34.244 million, although the employment rate edged down by 0.1 percentage points to 75.0%. So the number of people with second jobs decreased marginally to 1.287 million, according to accounting for 3.8% of those employed. The economic inactivity rate declined to 0.1 percentage points to 20.8%, with the number of inactive individuals falling by 38,000 to 9.042 million. So clearly, seeing the unemployment rate rally to 5.2%, a 5-year high, this is a red flag, and a worsening job market might only mean one thing: pressure on the Bank of England to cut interest rates. So from financial news, we don't have any major headlines except what we already discussed, with German CPI final year over year coming in at 2.1%. This was the same as the previous number, and also the same as the forecast. So nothing much of a change. It was the big surprise from the UK that got the markets jittered, with unemployment rate hitting 5.2% in the UK. And of course, the claimant count rising far much higher than expected, showing a worsening job market. So if you look at an Asian market wrap, or what happened in the Asian session before we just joined the London session, US equity index futures fell, implying that the multi-week decline in tech companies may continue as Wall Street investors returned from their holiday break on Tuesday. Treasuries rose and precious metals fell. Contrast for the SP 500, which have slid in each of the last 2 weeks to erase year-to-date gains, lost 0.5%, while those for the Nasdaq fell 0.9%. So the tech-heavy gauge has decreased for 3 weeks in a row, bringing it down around 2% year-to-date. US traders are back from their President's Day holiday on Monday. European stocks were likewise headed for a dismal start. Asian equities fell 0.2% in thin trade, with China, Hong Kong, and many regional markets closed for the Lunar New Year. Developments in the Middle East have refocused attention on geopolitical risk, while traders also consider the likelihood of Fed interest rate cuts following Friday's inflation report. Shifting sentiments about AI are adding to the concern, which is spreading beyond the technology sector, and the so-called AI panic trade emerges. Iranian Foreign Minister Abbas Araghchi met with the head of the UN's atomic watchdog in Geneva on Monday ahead of a second round of nuclear talks with the US. So those are the key highlights as of this morning. And of course, from the oil side, oil bears are dangerously underestimating geopolitical risk. The current sense of security in the oil market is false as the geopolitical risks from potential US-Iranian escalation, which recently pushed Brent crude up at $67, can still cause significant price shocks despite the rise of US shale. So while a disruption of the Strait of Hormuz could briefly affect 20% of global oil supply and cause major price jump, some analysts believe the world's increased energy efficiency would limit the long-term economic damage compared to previous decades. Geopolitical events are highly volatile, with scenarios ranging from a bearish diplomatic deal that would decrease Iranian oil production to bullish worst-case scenarios involving widespread conflict that could push oil prices past $100 per barrel. So it's very important that we follow the current negotiations between the US and Iran because both extremes could happen. On one side, if the negotiations don't go well and Iran decide to close the Strait of Hormuz, then we could be seeing a very strong rally in oil. But then if there's a progress in the negotiations, then a premium might be removed in the price of oil. And then we could be seeing prices dropping, perhaps even dangerously close to $59 per barrel. So on the Fed side, we are still quite a good number of days away from the next Fed decision. That's 29 days, and the market is still pricing in a probability of 90.2% that the Fed will not be cutting rates. It will not be hiking. It will be holding interest rates steady at a range of between 3.5 and 3.75%. So on the other hand, Wall Street flags quiet inflation signal lacking in the latest CPI data. So this is an analysis article from thestreet.com. So many cheered the January CPI inflation report, which showed the slowest headline inflation since May 2025. That's US inflation. But looking under the surface, some Wall Street economists have noticed price thickness that could mean the Fed's preferred inflation gauge. The personal consumption expenditures index tells a different story. And of course, we have seen that this data is coming up this Friday. So fast forward, just to shorten the article, the key highlight is that the Fed core PCE inflation rate of 2% is the target. They argue that that's a sweet spot that allows economic growth, supporting jobs without crimping budgets. So it's been particularly an elusive goal. The last time we saw core PCE at 2% was in early 2021, according to Trading Economics, before inflation skyrocketed in the wake of government stimulus checks and supply chain bottlenecks. So the CPI for January was heavily impacted by a drop in used car prices and lower shelter costs. However, BNP Paribas says that we shouldn't get overly excited about the lower CPI numbers because those tailwinds don't provide much long-term conviction that prices will continue falling. The components we view as most informative for the inflation trajectory surprise to the upside. Core goods ex vehicles was nearly double our forecast, notching its second fastest pace since the Trump administration imposed tariffs, suggesting that tariff pass-through outside the auto sector remains active. So the softness in core was overwhelmingly concentrated in used vehicles, which fell 1.84% month over month, a sharp miss against our expectation of a 0.25%, and knocking 7 basis points off the core compared to our forecast. So used vehicles tend to be volatile month to month, so we take little signal from the downside. Moreover, a pop in wholesale prices in January should transmit to a corresponding rise in retail prices in the coming months. So all this article is basically saying is that the sudden drop in US CPI was mainly attributed to the drop in prices of used cars. But then the other components of the CPI basket were rapidly rising. And now when you consider the wholesale report, then that's the producer price index, then the sudden increase in wholesale prices is bound to be transmitted into retail prices, and that would pressure the CPI to continue rising, basically saying that the banks disagree with what Trump was saying. So Trump was very quick to declare a win against inflation, but what the data is showing is that despite used car prices going down, retail prices are still moving up in other CPI basket components. So that's still a signal worth thinking about. Knowing that looking at the final details of the CPI report gives you more insight, not just looking at the overhead numbers. So as we proceed, we should know that our event on the 21st of February is getting closer and closer. So if you haven't booked your spot, make sure to book it right now. So it's a free event hosted by the Bullish Banda podcast. Me and my co-host Jesse Ogola will be taking you through the event. We have surprise guests from diverse backgrounds in crypto, in stocks, both local and international. We'll also be having a debate, and the debate will be whether it makes more sense to put your money in a pro farm account or whether you should go for a live trading account. So the debate, we also have professionals from both sides, people with a lot of experience trading with prop farms and people with a lot of experience trading in live accounts. So there we'll be able to discuss, look at the pros and cons, and at the end of the day, everyone will get out of the event more informed and more entertained. So we'll be starting at 9 a.m. at ALX Kenya, Piano Brookside Drive in Westlands. So make sure to register for this event. Drop a link in the comment section, and then from there, you're able to book your spot. See you on Saturday. Get to network with a lot of experienced traders. So I can see Mr. Patrick is in the house. Omaloa, thank you for joining. And Derry Musk is in the house. Thank you guys for joining. Also a good question on why unemployment claims are released more often. So unemployment claims are basically claims that people make when they can't find a job, basically claiming for unemployment insurance. And since this is a centralized data point, then it makes more sense to track the data per week. So unemployment claims are released in the US per week because the data is available, doesn't take out of processing. So this way, the market is able to get updated results every week. So it's mainly because it's a centralized database. People are basically claiming from the government and insurance companies, and working in one system, they're able to extract the data easily. It's not like the non-farm payrolls where they have to do surveys from across the economy and some data may be delayed. I believe that answers your question. And for those who are very new to trading, you should know that we have this course. It's called Novice to Pro. It's available on FXPesa YouTube channel. So from here, you're able to learn the basics from introduction to trading, charting skills, tradable assets, knowing your candlesticks, market structures, trading strategies, risk management, understanding market news, building a trading system, and also trading like a pro at the end. So make sure to check out the course, learn, have some self-paced learning. After each lesson, make sure you practice. You don't watch it like a TV show. And then once you're done, you'll be able to understand most of these concepts, and these will shorten your journey to becoming a pro-level trader. So also, for those who have been following the Bullish Banda podcast, you should know that we have a new episode. In this case, we featured a very pronounced market economist, Derry J. And make sure to check out the episode where we look at the Kenya's macro shift, ranging from the currency, movements of the Kenya shilling versus the US dollar. We looked at the Kenyan stock market, the trends in the Kenyan stock market, economic policy, as well as monetary policy. A very interesting discussion that might interest you. And of course, more and more episodes will be coming out each week. So if you just joined the session for the first time, then you should know that these sessions happen every day, Monday to Friday at exactly 11 a.m. So that being said, I believe now we can shift and move on to our favorite part of the presentation, and that is technical analysis, where we get to check the performance of gold. We also look at the performance of silver, major currency pairs. We also look at top equity market indices. And once we cover this, hopefully everyone will be able to trade from an informed perspective. So the chart right in front of you is the chart of gold traded against the USD. And this chart basically is on the MetaTrader 5 trading application, the app that we use for trading on a desktop or laptop computer. If you prefer trading using a smartphone, then search for the Equity Trader by FXPesa on your App Store as well as Play Store. And from there, you'll be able to access trading view-like charts. And you'll have a one-stop shop where you can make deposit and withdrawals free of charge using the app. So let's get to what's happening with gold. So on the daily time frame, you can see that gold has been on a very strong bullish momentum, having hit a new all-time high last month. So we almost got to $5,600 per ounce of gold before we had a sharp sell-off that lasted 3 days. So we dropped to basically 4,400. So this was a 21% drop before the market recovered half of the losses. So it was a very sharp recovery, then a sell-off, and then some more recovery. So last week was mostly sideways before the eventual drop towards the end of the week. This was the drop we were analyzing here. So in the last lesson we had, we analyzed this sideways momentum, and we said we wait for the eventual break. The break managed to happen on the lower side. So sometimes it's good to keep adjusting your trend lines based on what's happening. So when you see things change, you adjust your particular trend line to the current highs. So this is what you are having as per last week, and then a sharp drop happened here. Market attempted to do some recovery on Friday, but then on Monday, Tuesday, we have seen the market go for last week's low. So this was the low that we had seen here on on Thursday. So yesterday, price spent mostly in a bearish momentum. So since the market opened, you can see it was just more and more times going down. And then today, an even further drop. So what we saw from last week's close, this is a drop of 3.66%, with most of the sell-off happening early this morning, down 2.72%. But then since we had that liquidity grab, clearly there was some form of liquidity here. Anyone who had set their stop loss around this area, those stop loss have already been triggered, and the market bounced immediately. So from the 15-minute chart, you can see the strong rally, attempt to move back. So this was the Asian session low. So after the sharp drop, notice how the market went straight for it, and now it's struggling to break above it. But then, if you know what reversal mean inversion means, it means that whenever you have such a big move such as this one, sorry for that, a big move such as this one, sometimes the market will return back to where it started. So this played out in the Sydney session. So the market went straight back to where it had started before continuing with a sharp drop. And if the same was to play out here, then there would be a slow progression back to where it all started. This is where our next move started. So perhaps a progression all the way up to where this move had already started. However, this was a key level support, now turned into a resistance. So you can already see that the price of gold is really struggling to break above that. And if you look at the number of candlesticks that have hit this particular line, we are looking at 7 or 8 5-minute candlesticks that have been moving sideways here. So at some point, I expect some progression and a rally to the beginning or the origin of this move, which is around 49.53, perhaps an even further momentum higher towards the $5,000 price action level. Remember, the trend is still extremely bullish. So here, what we are seeing is a market attempting to make a pullback, but the idea is to continue proceeding higher and get to where the market had started. So sometimes it can be a bit chaotic. Notice how when the market was going for the main reversal, yes, there was some pullbacks here, but it kept pushing higher until it got to that area. So that could be in play yet again for the gold market. And if you look at silver, we had something similar playing out. So you look at last week's low, silver drops 2 candlesticks within the same day to the same level, but each time bouncing strongly from that low. But then also it's important to note that for silver market, there is this particular trend line that is acting as a resistance. So if you are bullish, then I would lower my expectations to somewhere around a retest of this particular trend line. Until it's broken, it seems like the market is in a structure that is a bit bearish. So from the H1 time frame, this is how it looks like. So we already wiped the lows that we had seen last week here. And after wiping that, you can see that bulls came in strongly, pushing prices higher. So we could be seeing some further upside momentum. So also important to notice is that the Nasdaq did something similar. So from Friday's low, we saw the market dipping right into it and then bouncing immediately. But now we are seeing the market pulling back downwards, which could imply some form of retest of the same area. So after the sharp drop in early morning trading, we had the strong bounce here. And then from the strong bounce, you can see what was in play here. So this was a low that we had seen here in the New York session on Friday. And then the market went for that level. And now what we are seeing here is a sharp drop that implies that we are going for a retest of this level again, 24,503. You look at the US 30, clearly showing some form of a strong bounce from this level here. So this was a pretty strong bounce, and this is playing right at key level support, which implies that the market could now be trading in a range. So the range could be defined as this area, where since the market got inside, it hasn't moved outside. So sideways momentum for 2 consecutive days. So in such a range, we know that we are coming from the lower side and headed to the upper side. So for the down, more likely we get to see the market stay in that range and retest the upper side of the range. So we look at the SP 500. No need to say much. What we are seeing here is clearly a sideways momentum market. This is on the 4-hour time frame, so a much bigger kind of range. So from this side to this side, we could say that for the entirety of this period, which is close to 10 weeks, we are basically looking at a market that is moving sideways. So what we are experiencing right now is a market that is testing the lower side of the range. And now at some point this week, we should be looking for a bounce and the market heading back to the upper side of the range. So for the UT 100, yes, it's going to retest, but the idea is still to be looking for bullish positions on the bounce. So perhaps we look at the 4-hour time frame, we look at the big sell-off that we have seen over the last 3 weeks, and now anticipate a potential bounce similar with what we had seen 2 weeks ago. So from the 1-hour time frame, yes, the market is attempting to go for that retest, but the idea is still to be looking for bullish momentum. On the daily, yes, we have some form of range, sideways momentum, I would say, for the last 1, 2, 3, 4 months. But then the idea is still pretty bullish to buy on the dips. So for the UK 100 index, so after the release of the week job market report, what we saw was the market spiking up higher. And this broke a key level resistance, which was yesterday's high. So after breaking above yesterday's high, what we are seeing is an acceleration higher. But then this acceleration is not straight up continuing towards the potential target. So what we are seeing here is a potential pullback that might be used as a trampoline to jump into the next resistance. So the next resistance is the prior high. So you go to the H1 chart, then this is the last all-time high we saw with the UK 100. So a bet that the market will go for a new all-time high means that you start looking for buys on the pullbacks. So a pullback here, as a bounce, would take us to a new all-time high. And from the daily time frame, you can see it's a very strong bullish market. So it makes more sense to be looking for more bullish opportunities. So the Hang Seng Index also did something similar, managed to grab a key level support, low of week. And then from there, you can see a very strong rally as of this morning, which implies that now the market is accelerating higher. And remember what I said about inversion to mean. So if this move started here and the market is reversing, then we could be seeing a slow progression to key level here. So a slow progression to around 27,000 price action level. So the bullish momentum seems particularly strong, especially as of this moment. So for the Nikkei 225 index, from the daily time frame, you can see it's still a very bullish market. But then we have the real opportunity of catching a pullback since last week was largely bearish. So from the H1 time frame, what we are seeing here is a market that is mainly consolidating. So if you look at the highs in this market, and then you look at the lows, then you'd notice that we are in some form of wedge pattern, and the market just bounced from the lower trend line here, which implies that we could be headed for the upper trend line and then a potential break on the upper trend line. So on the currency side, USD yen, we know that the yen has been strengthening ever since they won the elections. You look at last week was mainly just the dollar losing to the yen. And what we are seeing here is an attempt to move sideways met with a very strong selling pressure. So from here, you can tell that the market traded sideways for 4 days. And now we are in a straight up sell-off looking to retest this key level support. So for USD JPY traders, we know that we are testing here, and then a break would imply that we move even further downwards. So for the dollar Swiss franc, clearly a market in a consolidation. This basically means that the market is just moving sideways. So it doesn't take a professional to see that this is a triangle. And in a triangle, it basically means that the market is just consolidating. So at some point, we'll see a break. We haven't seen a break yet. So it's a watch, wait and see kind of market. And once we get that eventual break, then we'll have a direction to trade with. So for euro dollar, clearly a market going for yet another key level support. So notice how this was the upper side of the range. Market tests that upper side of the range, now turned into a support. And now, as of this morning, yes, the euro was weak, but then you can see the V-shaped dip. You grab some liquidity and you jump up higher. So clearly, this is a market that is showing signs of bullish momentum for the day, perhaps even for the week. And you look at also this key level support and how it has been playing out. So a breach inside here would likely imply that we move on higher, with the euro regaining some momentum against the dollar. So the pound, which just witnessed some news, notice after the sharp fall off, we might be in a play where the market reverses back to the mean. So this could be something similar with what happened with the non-farm payrolls last week, with the market making a big jump, but then eventually settling back where it had just started, especially for gold and US equities. So here we are seeing the market basically making a U-turn and going back to where it started. That's for the UK pound. So New Zealand USD, clearly market in a lot of noise, but still sideways momentum. So I wouldn't call this a particularly trend. I would say the market has been really trying to make a break, but that break doesn't seem to be coming. So what we are basically witnessing in this market is more of a range, more of a sideways momentum. For instance, you look at Friday, Monday, Tuesday, this is just sideways momentum for the New Zealand USD pair, and we'll be waiting for the eventual break. Dollar trading against the Canadian dollar. Here we are seeing a market that is really attempting to find support. So with about 6 consecutive trading sessions where the markets have been bullish, yes, the card is making an impressive recovery. So expect more bullish momentum, though it seems like this volatility seems to be winding down. So if this was the area of best fit for a trend line, then this could mean that we have a rising wedge, which could be dangerously close into making a breakout, and a breakout would imply that we go for a short trade, especially if the breakout happened on the lower side. So you look at AUD-USD, our current star in the currency markets. Clearly, this has been a pretty strong market. You go to the daily time frame, you can see the sharp rally that we have been experiencing in AUD-USD. So from there, you go to a smaller time frame, in this case, the H1 chart. Then you notice that rally seems to be slowing down. If you look at today's low, compare with the last week Friday's low, almost the same level. But then the highs from last week versus this week, they seem to be getting lower, which means that the market could be entering some form of consolidation. And if you look at the Friday's high versus yesterday's high, then this screams of a market that is moving sideways. And if it's a sideways market and we are just bouncing from the lower side, then the expectation is that we are moving towards the upper side of the range. So I believe I've covered most of the assets for today. Bitcoin are still strongly bearish. There seems to be some form of panic happening with the Bitcoin prices. So currently trading at $68,000 per Bitcoin. And of course, the lowest that we saw here, that was in the month of Feb, was $59,000 per Bitcoin. So attempts to recovery seems to be met with more selling pressure. And if you look at the sequence of highs from the last 2 weeks, the highs seems to be getting lower. And if you look at the lows from the last 2 weeks, also they seem to be getting lower. So more likely that we see a breach and further bearish momentum. So for the German stock market index, an attempt to breach here failed spectacularly last week. And right now, we are right back to the same pattern, which basically implies that we are back into the range. So the range wasn't that hard to identify. So over a span of 3 weeks, I would say here, this market was just moving sideways. So the attempt was to breach and move higher, which failed, and the market got back into pattern, which implies that now we could be headed much further downwards for the DAX index. The EU 50 also had a pullback happening late last week. And now you can see how this market is bit by bit creating some form of pattern here, indicating some form of channel. If you really look closer, you'll see the channel here. And now we are on a momentum downwards, looking to bounce from the lower side. So this seems like a premature bounce, but eventually this is the idea. So France 40 index. So we had this range. Last week we managed to identify this reversal and drop. And now since then we broke the lower trend line and has been moving sideways since then. So notice here from Friday, it doesn't seem like the market was prepared for any activity on Monday. So we didn't have much of a movement. Market opened with a gap today, closed the gap, but we are still moving sideways. Sorry guys, I lost my connection for a bit. Though I think we had covered pretty much everything we needed to cover for the day. So there's a question here. What's the difference between index markets compared to indices and futures markets? So index markets, you're basically looking at a benchmark. Indices are basically weighted mean averages of an entire stock market or a portion of it. So for instance, when you say US 500, you're looking at the weighted average of 500 companies in the US. And this basically is a bet on the stock market. So some indices are sector based. For instance, the Nasdaq 100 is mainly tech based or tech heavy, meaning that you're looking at the top 100 tech companies in the US. So it's basically betting on the US tech sector. So an index is singular and the plural is indices. So it's one word, different pronunciations. So index for one and indices for many. And also the futures markets. So futures markets are basically a bit of a different contract, and since futures are traded on a centralized exchange, you're able to track things such as volume, open interest in the futures markets, where it's very difficult to do that in a spot market for indices. So for spot indices, it's very difficult to track the orders or the liquidity in the market. But then for the futures markets, you are able to track that. So you can have all kinds of futures. There's currency futures, there's index futures, there's commodity futures, even crypto futures are available. So that is it for the day. Thank you very much, everyone, and I hope to see you on the next session. Remember to like, share, and subscribe, and set notifications on. If you're watching this on X, remember to retweet the session. Always appreciate when you guys share the sessions. If you're watching this on Facebook, make sure to share. And if you find it on any other platform, you're more than welcome to share. Remember, the sessions are recorded, so you can always rewatch later in your own due time. So that is it for the day. See you guys on the next session.